Non-current assets. Session aims. In this lesson, you will learn about non-current assets, assets that a firm intends to keep for more than 12 months. We will look at tangible and intangible assets, what they are and how they are accounted for, the commonalities and key differences. I will introduce depreciation and amortisation as measures to show how much of tangible and intangible assets have been used up. We'll look at this in more depth in lesson 8. I'll also look at other non-current assets, net pension assets and goodwill, what they represent and how they arise. And as usual, intended learning outcomes for this lesson. The firm's operating assets comprise its working capital, which we looked at in the previous lesson, and its non-current assets. Non-current assets are assets which the firm does not expect to sell, use up or dispose of in the next 12 months. Property, plant and equipment, which includes land, buildings, trucks, automobiles and machinery, makes up the largest part of non-current assets at most firms. These assets may be held and classified as operating assets or held for investment purposes. The accounting treatment of the two classes differs. Operating assets are held at historic cost, the acquisition cost less a portion of the amount that's been used up, while investment properties are held at an appraised value. This is a market-based valuation rather than reflecting the acquisition cost. Other non-current assets comprise intangible assets such as royalties and patents and associates and joint ventures and other financial investments and net pension assets. And finally, reported within non-current assets is goodwill. Goodwill is not an asset as such, but is reported within non-current assets. So we'll look at each one of these in more detail as we go through this lesson. So a reminder, recognition of assets on a balance sheet. Assets should be recognised on the balance sheet provided A, it is probable that any future economic benefit associated with the item will flow to or from the entity, and B, the item has a cost or value that can be measured with reliability. Property, plant and equipment held at historic cost comprises a firm's operating assets, and it's made up of land, office buildings, residential apartments, stores, warehouses, distribution centres, factories, oil refineries, buildings under construction, and includes any fixtures and fittings. And also includes machinery, computer and telecommunications hardware, including operating systems and other equipment, and transportation, planes, trains, trucks, vans, and automobiles. All of these are assets that are used within the building itself, and they're all held at what is called historic cost. The acquisition cost less an allowance for the using up of the assets over time. So we're going to go through the accounting for property, plant and equipment held at historic cost. And the first item we're going to look at is the gross value. This is a value which is reported in the notes to the account in exactly the same way as we had a gross accounts receivable number. So this is the value which is recorded here is the original cost of the asset. And the original cost of the asset depends upon how the firm acquired it. There's three possible ways in which it could have arrived on the firm's balance sheet. So let's look at each one of these. It could be exactly the same asset, but treated in three different ways. So we could have three different valuations for the same asset depending upon how it was acquired. The first and the easiest is simply that the firm has bought the asset from a third party, which it's been complete, and the amount that is recorded here is the historic purchase cost at that time. Alternatively, we might have a building that the firm has actually constructed itself. If this is the case, then the costs will reflect all of the construction costs. So that's going to include the raw materials, the direct labour costs, the machinery costs, and in fact these costs may include capitalised interest from any project-specific financing during the construction phase. And finally, the company might have acquired the asset as a result of what's called a business combination, as a result of it buying another firm and the firm owning the asset. As part of the process of the acquisition process, all of the assets are revalued, and so the particular asset would be recorded at the appraised value at the time of the transaction of the business combination or the acquisition. So three different methods. We potentially could have the same asset having three different values depending upon how it has arrived on the firm's balance sheet. Typically, firms will break down gross property, plant and equipment within the notes and by class. So we'll actually have one which has got property, another which has got equipment, another which may have transport, and the actual class breakdown will depend upon the sort of company and the sort of assets that it holds. So that's a gross. So in terms of the values, so this is reported in the notes. So gross PP&E at the end of the period is equal value at the start of the period plus the cost of additions less the purchase cost of assets that have been disposed of in the period. And let's look at an example. So the firm started the year with PP&E that it cost 1,250. It acquired new PP&E at a cost of 160. It sold equipment that it had originally bought for 95. It doesn't actually matter how much it obtained for it in the sale. So it ended the year with PP&E with a value of the starting value of 1,250 plus additions of 160 less the cost from the assets that were disposed of 95 gives the end of year value of 1,315 million. And that's just a note. The amount it sold the equipment for does not affect the value of the gross PP&E, only how much it originally cost. I'm going to introduce the concept of depreciation. Depreciation is the method that is used to take the cost of non-current assets. So all non-current assets are used up over the course of their lifetime and need to be replaced. The only non-current asset which does not get used up and need replacing is land. So depreciation is a process to match the cost of using up non-current assets against the revenues that it helps to generate. We're going to look at matching in a future lesson, but this is all to do with how we're coming up with a meaningful figure for profit. So we're trying to work out expenses against the revenues that they have helped to generate. So depreciation, process to match cost of using up non-current assets against revenues help generate. Depreciation is accumulated. As an asset ages, the charges are taken through the income statement, and the accumulated depreciation shows how much of the asset has actually been used up. This is a way to tell how much is effectively left. Accumulated depreciation is disclosed in the notes, as was the case with impairment allowance for accounts receivable. It is a contra asset and it has a negative sign, and it is netted against the gross value to give the net value, which is the one we actually see and is reported in the statement of financial position. Firms have a choice of depreciation methods that they can use to calculate depreciation charge, straight line, reducing balance. We'll look at these in more in detail when we look at depreciation as a topic. But for now, we're just going to look at the effects in terms of the statement of financial position. So accumulated depreciation at the end of the period is equal to the value at the start of the period plus the depreciation charge in the period, which was taken through the income statement as an expense, less accumulated depreciation of assets disposed of. So let's look at an example. So I'll use the same numbers as in the previous example. Started the year with PP&E that it cost 1,250 million, with accumulated depreciation of 675 million. It took a depreciation charge of 125 million through the income statement for the year, and it sold equipment that it had bought for 95 million that had 75 million in accumulated depreciation. So it ended the year with accumulated depreciation of 675 million at the start, plus the charge of 125 million, less the 75 million in depreciation in assets that were disposed of, giving us 725 million. Net book value. The value which is actually reported in the statement of financial position is the purchase cost, so that the value which is recorded under the gross value less accumulated depreciation. It's commonly referred to as net book value. So property, plant and equipment reported in balance sheet is equal to gross property, plant and equipment less accumulated depreciation, which are both reported in the notes. So let's finish off our example. So it started the year with PP&E that cost 1,250, with accumulation depreciation of 675 million. The net value for property, plant and equipment at the start of the year was 1,250. The gross value less accumulated depreciation of 675. The net book value was $575 million. And it ended the year with gross PP&E of 1,315 million, with accumulated depreciation of 725 million. The net value for property, plant and equipment reported on the statement of financial position at the end of the year was 1,315 less 725. Accumulated depreciation is equal to $519 million. Let's have a look at Morrison's property, plant and equipment disclosures. IFRS disclosures for property, plant and equipment are considerably better than those that are under US GAAP. So what we have here is a breakdown between freehold land, freehold buildings, leasehold land and buildings, plant, equipment, fixtures and vehicles. And unsurprisingly, the largest of these are the land and the buildings. So purchase cost. So for freehold land, we've got purchase cost, accumulated depreciation. So purchase cost of 3,948 million, less accumulated depreciation of 601 million, net book value of 3,347 million, all the way through. So the total purchase cost of its property, plant and equipment, £10,552 million, less accumulated depreciation of £3,391 million, gives £7,227 million net book value. And there's a note here that I've made. There is depreciation in the freehold land. That is for costs above the purchase cost that were spent on preparing the land for development. Land itself is not normally depreciated. Let's go through an example of showing full disclosure. So a company owns, all of the figures here are in thousands. A company owns equipment it bought for 1,200, which since its purchase has accumulated 520 in depreciation, giving it a net book value of 680 in the statement of financial position at the start of the year. The firm disposed of equipment which it bought for £400 for 165, and we can see that the accumulated depreciation on the equipment that it sold was 220, and the net book value was 180. So if it sold it for 165, net book value of 180, it took a 15 loss on the sale. That will not be reported here, it will be reported within the income statement as a loss. During the year, the company bought new equipment costing 650, so that's additions, and took a depreciation charge of 300 through the income statement. And pulling those together, at the end of the year, gross value is 1,450, so that's 1,200, less 400 plus the additions 650. Accumulated depreciation, so it started with minus 520, and 220 went out in terms of disposals, and there was a charge of 300. So at the end of the year, the accumulated depreciation is minus 600, and the net book value is 1,450 less 600 is £850,000. And let's see if we can look at this graphically. So start the year 1,200. So the gross figure went down by the amounts it disposed, which is 400, but also bought 650. So the gross amount at the end of the year is 1,450. So that's reported in the notes. And in terms of accumulated depreciation, it started as 520, £220 in accumulated depreciation went from disposals, and then we had a charge for the year of 300. So the total accumulated depreciation at the end of the year is 600. And So the net book value at the start of the year is 680, which is the difference between the 1,200 in gross value less the 520 at the start of the year, and at the end of the year is 850, which comes from the gross value of 1,450 less the accumulated depreciation at the end of the year of 600. Let's move on to investment property. So investment property are typically assets which are rented out to third parties. So firms which are renting out buildings or equipment might well classify this property as investment property. For property and plant which is reported at historic costs, it's all on the basis of how much it cost originally less accumulated depreciation. It does not look at the current market or replacement cost in any way. Investment property, however, is property held for investment or trading purposes include buildings owned and rented out. So investment properties are reported at what is often called fair value. By fair value, they mean a current appraised value, looking at current market prices of similar assets, and gains and losses on that reappraised value are taken through the income statement as a gain or loss. So the periodic revaluations of investment property will result on gains or losses, which are taken through the income statement, and those are based on current market prices. The reported values for investment properties are estimates of current market prices, what they could be sold for if sold in an orderly way, based on prices of recent transactions of similar properties in the market. This is obviously subjective. This is one valuer's estimate will differ from another's. This is not based on no two properties are identical. This is trying to look at properties which are similar and using judgment to arrive at a fair value. And the value on the balance sheet, so this is what's reported in the statement of financial condition, is value at the start of the year plus or minus changes in appraised market value, plus the cost of any additions minus the book value of any assets which have been disposed of during the year. Let's move on to intangible assets. So patents, copyright, performance rights, trademarks, mineral rights, operating licenses, copyright, titles, brands, licenses, royalty rights. Increasing importance. Intangible assets comprise assets that have no physical form, but whose value is measurable and from which the firm can be expected to gain a future economic benefit. Intangible assets are increasingly important to firms in developed markets, intellectual property rights of one form or another. Unfortunately, current accounting standards do not allow for most intangible assets to be included in company financial reports. Firms are required to expense research costs. They're also required to expense marketing costs, so that they are not permitted to capitalize intangible asset development expenses, even when they can be identified as directed towards the creation of a specific asset. So if a company spends a lot of money promoting, advertising a new market title or a brand, it cannot capitalize that expense and attribute that expense to a cost to be used for the value of a magazine title or brand on the balance sheet. So all of these expenses are expensed, and intangible assets which are developed in-house do not appear on the balance sheet, which means that the value for intangible assets at technology and bio companies is seriously understated, because it does not include intangible assets developed in-house. So they do not appear in the financial statement unless they have either been bought separately from another company. So we might have a big drug company buying a patent from a small research outfit, in which case we would have a valuation, the valuation based on how much the big drug company paid the research outfit for the patent, or as a result of a business combination. If one firm buys another firm, all of the assets, both tangible and intangible, are valued at the time. And these intangible assets, which did not previously appear on the balance sheet at the firm being acquired, will now have a value attributed to them. And that value will be based on some method of looking at similar valuations in the market of when they have been sold separately, or using some discounted valuation method. Computer software and computer application systems, the accounting is somewhat different to that of other intangible assets. So computer software includes application software and operating system software bundled with software. Accounting treatment of computer software is more complex than for other intangibles. Development costs for systems for in-house use only are expensive. So that's exactly the same as other intangible assets. However, applications bought from third parties are held at purchase cost in the balance sheet. So if a company farms out, if it contracts out systems development to other companies, then software will appear on the balance sheet. Whilst if it developed that software itself, it would not appear on the balance sheet. And software acquired from business combinations is also revalued, and it's reported initially at the appraised economic value that was put on that software at the time that the acquisition took place. And the cost of bundled operating systems, so software which is necessary for running hardware, is treated as part of the hardware costs and reported on non-current assets, effectively as a tangible asset, rather than being treated as an intangible asset. The rules for software developers and resellers differ somewhat from those that I've given here. Amortisation. Some intangible assets, so brands and titles, have no finite expected economic life, and they remain in the statement of financial position at cost. But there are other intangible assets. Patents and licenses often have legal finite economic lives, and computer software has a finite economic life in practice. And these wear out effectively in the same way as non-current assets. And amortization is the process whereby the cost of using up intangible assets is taken and matched against revenue. So amortization is for intangible assets as depreciation is for tangible assets. So these sorts of intangible assets that have a finite economic life are amortized over their useful economic life. So we'll look at some other non-current assets. So I'm going to look at net pension assets, associates, and goodwill. Goodwill is not actually an asset, but it is reported within non-current assets. I'm not going to spend time on joint ventures or financial investments. Net pension assets. Net pension assets only appears on the balance sheet at firms where their defined benefit pension plans have a surplus. So the pension plans are an off-balance sheet item whereby the company guarantees certain benefits to its employees post-retirement, and there are assets which have been invested to help meet meet those liabilities. Where those assets are greater than the present value of those liabilities, the firm has a surplus. And that surplus is reported on the balance sheet as a net pension asset. So net pension asset is equal to the value of the plan assets minus the defined benefit obligations, which is the value of the present value of the promises which have been made to employees in their retirement. We don't need to spend a lot of time on this today. The plan assets are held at a market value. The defined benefit obligation, the value for this is arrived at as a result of a series of actuarial assumptions in terms of how long people will live for after retirement, how many years they will work until they retire, and a series of other assumptions. You don't tend to see this very often because most plans have a deficit. Associates. So associates are companies in which the firm has a stake and it has significant influence but no overall control. This is usually interpreted as meaning that the firm owns 20% or more of the shares, but less than 50% of issued shares. If it owns more than 50%, it is a subsidiary of the firm rather than an associate. And the accounting treatment, the investment is initially recognised at the price paid to acquire the stake in the associate, so the purchase cost, the fair value at that time, and this value is subsequently adjusted by the firm's share of profit and losses of the associate, less any dividends received from it. Goodwill arises as a result of the accounting treatment of acquisitions. It's not an asset as such. It is necessary to make the balance sheet balance, and this is reported within non-current assets, even though it's not an asset. Let's look at the theory first, and then we'll go through an example. So when one firm, the acquirer, buys another, the target, all of the target's assets are revalued to a current market price or an appraised value, which we've talked about already, on the day that the acquisition takes place. The target's liabilities at that time are then netted against the revalued assets to give a value for net assets. Goodwill is the difference between the price being paid by the acquirer and the target's net assets. So let's go through an example to try to show it more clearly. So we've got a larger acquiring firm that has equity of $4 million, has assets of 12 million, cash of 5, and 7 million in other assets, and liabilities of 8 million. And it's buying a smaller firm, the target for 3.5 million in cash. Let's go through this. So that's what the balance sheet of the acquirer looks like at the start. So equity of 4, liabilities of 8, funding, cash of 5, and other assets of 7. And it is acquiring a firm which has got revalued assets of $4 million and liabilities of 3 million. So its net assets is 4 million less 3 million is $1 million. The acquirer is paying 3.5 million in cash for the company, so that goes to the owners of the target, whose stake in the company is being bought out. So the post-acquisition, the firm after the acquisition will have the liabilities at the acquirer before the acquisition, plus the other assets from the acquirer. We then need to reflect the fact that cash is now down. So it started with cash of 5 million. It's paid 3.5 million for the company, so it's got 1.5 million in cash. It inherits or takes over the liabilities of the target, which are $3 million. And it also has the revalued assets of the target, which are 4 million. And in order for the balance sheet to balance, we need goodwill of 2.5 million, which is the difference between the price being paid of 3.5 million and the net assets of the firm, and that makes the balance sheet post-acquisition balance. So goodwill is not an item that you can pick up and carry. Its value depends upon two things. Its value depends upon the assessment of the appraised value of the target's assets and the price that the acquirer is paying for the target. So let's just finish up by looking at Morrison's assets at the end of 2007. So we've got current assets of 1,176,000,000, and then we've got the property, plant and equipment that we've already looked at. It's got a very small number for investment properties. It's got intangible assets, some software development costs and some licenses. So if you've got software development costs appearing on the balance sheet, it means that it has contracted that work out to third parties. Very small number for goodwill. It's not an acquisitive company. And its net pension assets are £4,455 million, but its liabilities, defined benefit obligation, is only £4,162,000,000. So it's got Net pension assets of 263. Total non-current assets, £8,070 million. Total assets of 9,246 million. So current assets are a very small portion of Morrison's total assets. So in this lesson, we've looked at non-current assets, tangible and intangible, and we've focused on property, plant and equipment, both at historic cost and at appraised value. We've looked at intangible assets, and we've looked at other non-current assets and goodwill.